Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Surabhi. And guys, good morning.
Morning.
Somehow, it doesn't look like we are coming out of a holiday, right? It just looks continuous. Like It never ended. We never went anywhere. We were right here because markets are doing exactly that.
I was wondering, Prashant, what you've been up to between Besant and Navarro and Hesset and Trump and then Musk is saying something and someone's speaking on CNBC, someone's speaking on CNN. I gave up trying to follow beyond the point. But Prashant is our man. He'll keep us up to speed on everything that's happening on that roller coaster.
Well, that's right. And at least with all the cues that we've got, at least a positive start is what we could brace ourselves for. And it'll get very, very interesting from there.
And Surabhi, we were talking about today's Friday, right?
Yeah.
So the Wednesday morning, the last day, we were talking about
one headline away from things turning.
Yeah. No, I was talking about the bond market thing.
Yeah.
Which we started discussing at about 9 o'clock.
Because the yield had shot up to about 4.5.
I think it was about 9 o'clock, 9:05?
9:30 when it was midnight and those tariffs hit, suddenly markets
9:30,
were 9:30. They started moving, big time.
That is essentially what has caused this. Apparently, that is what has caused this U-turn, this pullback, back from the brink, or whatever you want to call it. But it's not all settled. And I think that's the important point which we will take forward because it's all incremental. I mean, unless you've been living under a rock, you know that the sort of tariffs have been paused for 90 days for all countries except China. So let me just quickly recap things, just a change, right, on the equity indices and macro markets over the last 2 days because we'll be reacting to US on Wednesday and US last night as well. So the S&P is up 6%. These numbers look much bigger if you were looking at them yesterday morning, but we were not around yesterday morning because indices rallied 10, 12, 13%. But last night they gave up 4-5%. So this is the net change. S&P 6%, Nasdaq about 7.85%. The CBOE VIX, came off very sharply. I think it fell 35% the previous day. Yesterday it went up some 20%. So the net change is minus 15. The CBOE VIX. And the other markets, right? The 10-year yield is up 12 basis points. You have the dollar index, which is down about 2.3%. And Brent prices, again, have seen, 4% swings, 4-3% swings. So that's 1.7% net change higher in terms of the reaction that we've seen. Now, before I get into some of the other stuff which I think is relevant from here on. So the net change is positive. So you will get that reaction today, and the market will look a little better as compared to where we left off on Wednesday. Because you're going to be reacting to 5-6% changes net over the last 2 days to US equity indices. But I think the bigger story, and this is the reason why what gives people is giving people a lot of cause for worry, and why people are saying we are still in a flux, is the bond market, and this quote should come up. Which I think is very instructive. I mean, it's not from now. It's basically back from, the GFC, the global financial crisis. Timothy Geithner, if you remember, was the U.S. Treasury Secretary from 2009 to 2013. And, this is what he said. I used to think that if there was reincarnation, I wanted to come back as the president or the Pope. But now I think I'd much rather come back as the bond market. You can intimidate everybody. And I think that very, clearly and in a very pointed way tells you what really happened. So let me just quickly run you through that, right? So Trump basically did acknowledge, and we don't have to go by hearsay or, by kind of sort of trying to interpret things. He very much clearly, the graphics will come up. He said, the bond market is very tricky. I was watching it. I saw last night where people were getting a little queasy. Not the most eloquent way to describe what was happening in the bond market, but he acknowledged it in his own way, that it was the bond market which forced him to pull back at the last minute. And of course, maybe, discussions with Secretary Besant, who's a market veteran, etc. So this is very clearly the issue. Bond yields were ripping higher. And the issue is this. In times of risk off, when equities are selling off and there is stress generally, yields should bonds are a source of safety, especially U.S. treasuries are a safe haven. But they did not act like a safe haven. they were actually, yields were higher and they were going higher and higher and prices were falling, which is not what should be happening. And I think this is the basic underlying worry. You also had comments from, Federal Reserve representative, disruptions, and this is from last night, by the way, disruptions in Treasury market were instructive, watching Treasury market minute by minute. So this is from last night. Now, U.S. bond markets are still very much in focus, as we speak. That is because over the last 2 days, Wednesday and then yesterday, you have had two successful auctions. One in the 10-year, the second is the 30-year tenor. So two successful auctions. What should yields do? Yields should fall, right? Well, what has happened? Yields are higher, especially on the long end. If you look at the 30-year yield, it's up 13 basis points last night, and we are very close to 5%. I mean, so that is not falling. And I think this is essentially basically the issue. Now the fundamentals, U.S. growth concerns are still intact. The effective average tariff rate 2 days back was 25%, right? Pre-Trump, when Trump came into office, it was 2.3. It went to 25 as he kind of sort of attacked everybody. He's pulled back from everywhere except China. The effective tariff rate is still 20. It was just 25 72 hours ago. So these growth concerns are still there. Many global banks still have a recession forecast. The odds are they've brought a little lower. And of course, US and China are moving into a full-blown trade war. It's 145%, by the way, on China in terms of tariffs, which Trump clarified. And of course, will there be reconciliation? Hopefully there will be. On Wednesday, I was saying perhaps it's a 10-12-day problem and this will get resolved. Will the same happen with China? Hopefully, fingers crossed, yes. So Trump essentially has said that, a phone call will happen at some point and we'll be off to the races, his comments. But he's also promised at the same time tariffs on pharma, semiconductors, agriculture, etc. But I think generally the sting has gone away, especially with regards to tariffs, because he tried something and it didn't quite work out as he thought it would. So just to circle in the levels, tying the levels here. So the Nifty 40-hourly exponential moving average is 22,642. That's about 250 points away from where we are. But beyond that, the upside level for the Nifty is 22,806, which is and then 23,057. I put these levels on Friday. These are not moving averages, so they don't change their retracement levels. And that's the 50 and the 61.8% retracement of the fall. The Bank Nifty resistance, similarly, is the 61.8% retracement, which we almost got to on Tuesday. 50,848 is that number. And then after that, the swing high comes in, which is 52,063. So that's the picture. GIFT Nifty will come up on your screen. Effectively, it'll tell you how we are likely to start. It's 460 points on the GIFT Nifty compared to Wednesday's close. Surabhi.
Prashant, you're saying queasy. Queasy is a proper word. It's an English word. I went back and heard that soundbite so many times because I couldn't believe that's how he's describing it. He's saying people in the bond market, they were getting a little yippee. Yippee. So, I don't know. I've heard yippee with a very different connotation up until, Thursday. Yeah. Thursday morning. So, yippee was what perhaps made him change. Anyway, let's talk about the reaction that we're getting across Asia. The markets now here, because we had the fall overnight and the fact that US futures are lower, markets across Asia have resumed a bit of their slide. So Japan surged 9% yesterday on the pause. This morning, it's down 5%. So it's given off a little more than half of that gain. If I look at some of the other regional markets as well, the Australian markets are down about 2.5%. Let's look at what's happening across Hong Kong. Hong Kong slightly lower, 0.7% lower. Shanghai is, on its own path. Shanghai is actually, flat, which makes it right now the best performing market. It's not falling too much. Others are down. Singapore is down about 2%. South Korea is down. All those markets are down quite a bit. Okay, now beyond that, we have to look at where the final sort of numbers lie. What we know as of now is it's the tariff levy is 145% on China. On autos, aluminum and goods which are not part of the US, Canada and Mexico trade agreement, the tariffs remain at 25%. And for the rest of the world, including for us here in India, the tariff now is at 10%, and this 90-day window has opened up for negotiation. By the way, the EU, because of this 90-day pause, the EU also decided to halt its retaliatory strike. The EU had, geared up with slightly higher tariffs on specific targeted products, but they've held off from it for another 90 days as well. What's interesting is that in all of this, between last night and this morning, gold has surged. The dollar has absolutely nosedived. The dollar index is, look at that, just about 100. And gold continues to charge higher. There's simply no stopping it. levels of 3,200 plus on the precious metal. Now, where are we in this entire market fall? Just to put this crazy April in context so far, we're down about 5.5% at the headline level, index level. Nifty is down 4.7, mid-cap is down 4, small-cap index is down a little over 5, and it's the global-facing sectors, metals and IT, they've taken it on the chin. Look at the cuts there already so far, not even halfway through April, and we're down 13.7% on the metals index and about 12% on the IT index. Will this stop? Will this slide stop or not? Let's talk about the fund flows. Well, that's not where we're getting any help because FPIs have been continuous sellers so far in April. Even on the previous trading session, they went ahead and sold equities to the tune of about 4,300 crores. There was, some support from domestic institutions, about 3,000 crores of buying coming in from DIIs. Speaking of DII flows today, it's the mutual fund data. So that's important, very important to watch because in February, we saw the first sign of skittishness. The February net equity inflows were down 25% over January, and there was a lot of money moving out of mid-caps and small caps. So let's see if that trend continued in March or whether it was arrested or not. Finally, obviously, we'll spend a fair bit of time talking about TCS today. I'll tell you the headline. I mean, there's nothing really exciting out there. The numbers are slightly, just a shade below, very muted expectations. So what do we have? We have dollar revenue declining 1%. Constant currency growth at 2.5% is the lowest TCS has delivered in the last 4 quarters, lowest of FY25. On this whole tariff storm, what the company has said so far in the press conference, and of course we'll get more specific commentary, they're saying they haven't seen any major project cancellations, but there are some ramp downs and delays in decision making. Obviously, the company's margins have also, come out lower than expectations. And so far, no announcement of a wage hike. They're saying they'll do it, but they've just deferred it. They'll decide on it in a bit. So TCS is slightly negative Q this morning. Nigel.
Well, today, I think the big Q is not where we're going to start because everyone knows we're going to be starting off in the green. The question is, where do we end? And that's going to be the key factor for today's trade itself. We look at the Troika, and 2 out of the 3 are well behaved. The dollar index is very, very weak. The Brent crude prices are lower. Both those 2 are Indian market positive. However, the bond yields have spiked up, and that's a bit of a worry. It's a menace not only for President Trump and his plan, because otherwise the plan was working out perfectly. Yields had come down to around 4% or thereabouts. Then he had to rethink, and this is a bit of a menace for equities as an asset class globally as well. Moving on then, how much, can Indian markets outperform? That's going to be important because on the way down, we did outperform. We fell less than what the globe did fall. Now, on the way up, can we do even better? That's going to be important because there are a lot of factors at play. The FI shorts, well, they have been getting added on. So if you look at the short positioning from around 30,000 contracts, in the last few trading sessions, it's moved up by close to around 4 times. And the FIs, actually, they've been successful because the Nifty as well has seen a correction of close to around, 1,000 points or thereabouts. So they've got the direction right. A short squeeze holds the key today, whether or not we can end virtually at the day's high. So the FIs covering their shorts is the most important factor for me for today's trading session. Moving on then, let's look at the options data. Call writing was very, very aggressive, as you can see. So we'll keep an eye out on some of these strikes. Do we start seeing some unwinding? That's what will tell you that the call writers are getting nervous and the bulls are fighting back. So keep an eye out on some call writing because in the last few trading sessions, the call writing has been very, very aggressive. Which brings us to the levels. The important levels on the Nifty should come up for you on the screen. The 22,900 to around 23,000 mark is very, very important. 20 and 50 DMA come in out there. So by the end of trade, you'll want to end closer to that mark. On the Nifty Bank, well, that was doing a relative outperformance. Then it cooled off a little bit. You've got your first hurdle at around the 200 DMA, and that's going to be very, very important. If we get past that, then the recent high comes into question. But that's the important mark you're looking at. Stocks that I'm looking at metals. Why is that? Because the dollar index has cooled off, which is normally positive for metal prices. The other factor is that the metal stocks have got smashed. And for both these two names, we have company-specific triggers. For Tata Steel, they're talking about cutting cost at Netherlands, so that's a positive. And for Vedanta, we have a special situation that's playing out. Both these two stocks will start off well in the green. Let's see how they do from there, because the problem if a globe is going to go into a recessionary trend, then that's what will weigh on there. But otherwise, both these two stocks should do quite well.
All right, Nigel, thanks very much for that. So metals on Nigel's radar as we start today's session. Let's just get you some views here. So Michael Gapon of Morgan Stanley says that the 90-day delay in reciprocal tariff reduces immediate downside risk, but prolongs uncertainty. And with the effective tariff rate at 23%, there is a narrow gap between a slow growth outlook and a downturn. The U.S. economy is still living on the edge. They maintain their outlook for no Fed rate cuts in 2025 and backloaded cuts in 2026 for a terminal rate of 2.5 to 2.75%. He adds a downturn could bring rate cuts forward.
All right, on equities, Mahesh Nadurkar of Jefferies says amidst global uncertainties, absolute index performance is difficult to predict, but India should emerge as a relative outperformer. Lesser dependence to US and China demand, relatively lower tariff incidence, lower oil prices, low FPI weights, and a pro-growth RBI stance are the key reasons. Their preferred sectors in India are lenders, power, telecom, autos, and real estate.